Hello, welcome to Fintech Diary. My name is Amol Dethe, and I'm in conversation with Ranvir Singh, the founder and CEO of Ring, which was earlier known as Krish. Ranvir, glad to have you here.
So Amol, thanks a lot for inviting me. It's truly a pleasure being invited here and talk about what we are doing on fintech. Just as a clarification, we have one company, and within that we run two brands. Ring is basically going to be the more frontier brand, and we are in the process of moving from Kish to Ring. So the company is same, but yeah, both the brand we cater to.
Absolutely, Ranvir. So to begin with, Ranvir, I have been reading a lot about Ring, and I have seen you talking about Ring, and the shift from Kish to Ring. Just tell me something to understand. Basically, is how the Ring is shaping up. How has been the transformation from the Kish to Ring, and how is it shaping up? And also to understand, in a far more meaningful manner, if you could give us a sense on your dashboard in terms of how many customers do you have right now? How many merchants are you working with? How many downloads are happening? If you could give us some sense on that number on that side as well.
So first and foremost, to talk about the Kish to Ring journey and why we started Ring. See, as you know, we are in credit business. We do unsecured PL. But close to around 2 years back, we identified the big area where we want to focus on is the transaction credit. There are different names to this. We call it embedded finance, transaction credit, basically purchase finance, credit being offered at point of sale. And we realized that if we have to focus on that in a big way, there is a need to have credit and payments come together. Because you are trying to do the transaction while the customer is trying to make the payment at the store. That's only one part of it. There are several other parts which are around how do you create an experience for the customer, which is perhaps better than a credit card experience, where not only what you offer them as credit, they can use the credit to use for any and every kind of purchases. These purchases may not be on the offline side, but it may be also on all the e-commerce side, plus all the other benefits that come with it, right? Which would mean the reward points, the cashback. There are always a section of customers who value that aspect much better. And we said, if we have to cater to our customers in a very holistic, very wholesome manner, then it has to be done under a different brand with a different, outreach to a set of players who value transaction convenience over others. And that's what the whole rationale for going for rechristening ourselves into a Ring thing. Now, in terms of the scale that you mentioned, today as we speak, we have had a extremely good run, particularly in the last 12 months since we started Ring. We cater to close to around 8 million customers. 30% of those customers are active at any particular month. So they are doing transactions. And when I say active, they may be doing close to around 3 to 4 transactions per month. So we are talking about, upwards of 20 million transactions which are happening. All the transactions, 100% transactions are credit backed. So we give credit to the customer, which then gets used. And once the journey starts with transaction credit, we have a model where we end up giving the customers the longer tenure loan. A longer tenure loan could mean 6 months, 12 months loan, that kind of a thing. Just in terms of other business metrics, we are operating entire India, right from east to west, north to south. There are, tier 5, tier 6 cities because it's a digital model. So we are agnostic to locations. And once we give the credit, this credit can then be used from anywhere till the time you are in the geographical bounds of India. So that's, in a quick nutshell, the scale at which we are currently operating.
Thanks for sharing that basic information about the company and how it is working. And I think 8 million customers is not a small number for sure. So thanks for sharing that, Ranvir. Now let me get into little specifics and try to learn more from it. I think you started in 2016, if I'm not wrong. It's more than 6-7 years. What kind of major changes that you have seen specifically in the fintech industry? And where are we today? Considering most of the fintechs now talking about the profitability, or they are not talking just about acquiring customers. So how has the whole market changed in the last 6 to 7 years, Ranvir?
I think it's been slightly less than 6 years since we have been in the business. And if I have to reflect on the trends over the last few years, I mean, barring some of the, monumental, changes we have all seen, which is the COVID and many other things. But I think there are three things which are worth mentioning, which has had some structural impact as far as the shaping of fintech industry is concerned. I think first and foremost, just the tech infrastructure and the availability of that, the seamlessness of that, the way it has been available. I know it's a cliche to say that UPI is now rather pervasive, but in the last 6 years, we have seen actually the transactions of UPI grow from almost a very puny number to a gargantuan number that we have today. And it is not only UPI, it has come along with other infrastructure, which is the way digital KYC is happening, the way some of the other infrastructures are developed, which is more around being able to transfer the money in customers' account immediately, being able to underwrite customers on the back of digital data, bank accounts and everything, of course, is there with 100% of the customers. So you can cater to that customer almost without having the physical touch and feel, which was the traditional way of catering to customers. So I think that's one thing which has happened, which is the entire development of the tech ecosystem to cater to the customers. I think the second big thing which has happened is companies have evolved to a specialization level, which perhaps was completely unimaginable 5-6 years back.
Right.
So we as a company specialize in lending and transaction credit. Similarly, there are companies who specialize purely on payments, the Google Pays and the Phone Pays of the world, payments on mostly the micro payments. That has been nothing less than a revolution. And that specialization then has happened in many other areas. There are companies focused on insurance, focused on wealth, focused on, just providing different services so that in fact, any and every company can become, tech oriented in that sense.
Right.
So that's the second thing which has happened. I think the last, but definitely not the, maybe the most important part is the kind of scale we are talking about now is again at a very different level. I mean, there was a time when one would say that fintechs are mere, I would say, an afterthought. The banks continue to remain big behemoths. But I think increasingly now it is not debated that the traditional banking approach is very tentative. With every passing day, I think they are catering to, more and more of what is left, call it a less customer that they are left with. And I don't think they see this as, somebody taking their turf, but there is a new, I would say the roles are getting cast in a different way. Right. Banks are becoming a provider of capital. They are playing a bigger role in terms of, perhaps SME and the larger corporate. But when it comes to systems where technology, data, and being able to create a unique customer experience is concerned, I think some of the fintechs have taken big leaps, and that has added to the scale. But having said that, I don't think we still have, when I say we, the fintech industry has reached a scale where one can say it's a formidable competition to the banking industry. It is there, but I think in the days to come, one would see much more of that. So I think those three trends are very, very prominent. I think last but not the least, which is more, not so much of a fintech trend, but which has added to the whole ecosystem development is there are many players who otherwise, quote unquote, were not involved in financial intermediation. So they will never qualify as banking or a fintech company, have now become as much as a banking or a fintech company. And here I'm referring to, companies like Amazon or for that matter, Swiggy, Zomato, the large people who understand the power of being able to aggregate customer, being able to create an experience, particularly around convenience. And that's another one trend which is more prominent in the last 2-3 years post-COVID when everything was moving towards a digital world. Right. Which perhaps will continue in future also in a big way.
Again, quite meaningful, Ranvir. Let me be very specific and ask or maybe learn from you in terms of a founder's perspective here. Considering the whole ecosystem has changed, and when you say that, the traditional banking approach is going to be really tentative, So the model which is working out right now for the fintechs and the banks is the collaborative model. So now, given the fact that the fintechs are showcasing their innovation far more aggressively, and on the other side, the banks also realize the value of the fintechs. Are you, as a founder, as a CEO, trying your best to maybe generate more value out of the collaborations between the banks and the fintechs? Are you charging more to the banks for the innovation you are offering, or maybe the kind of partnerships that you are building with them?
I think what you are raising a very, very important point, Amol. You realize is, I think there are few things which are rather important from a founder or a CEO perspective as far as this collaboration goes. I think first and foremost, it's a thing which now is a undisputed truth here that things will get developed in a collaborative mode. So it's not as if there are a set of banks sitting on one side of the fence, there are people sitting on the other side of fence, and they're trying to out compete each other while being in the silos. No, I think it's a given thing that the model that will exist will be one of collaboration. Perhaps I'm stating the obvious, but a very, very important thing, because this is not something which was there perhaps 2-3 years back. Whether that collaboration has fully played out in the commercial models, I don't think so. And part of it is because, there are many shades and colors of, banks, and similarly shades and colors of fintech industry which exists. And at the end of the day, it's a market, and there's no one factor that defines pricing. So just because I own a lot of customers, I'm driving innovation, am I being able to charge higher to the bank? The answer is perhaps not a resounding yes, but it is moving in the right direction. When I say moving in the right direction, where one is able to ask legitimately for the value that one is bringing on the table. And sometimes the words like innovation can be very vague and vaguely deployed, but I think the big thing is customer ownership. So if you have customer ownership, you are able to go and charge the same, perhaps a tad more, or higher to the bank. And bank, not one, but many banks have opened to the idea that here is a fintech which brings this expertise of data and customer. The data helps in understanding the customer better, underwriting it better, creating a right offering for them. And that plays very well in the contractual agreement that we have done. That also has played in a big way in almost many fintechs, not only us, but many other fintechs, moving to a model where they are increasingly becoming profitable or have already become profitable. So we have been profitable for the last 3 years almost. And then as we project for future, as much as we see a competition and we see we need to invest in growth in a big way, but given the way, the economic structures have evolved, it is almost given that the profitability is here to stay. So that's how I'll characterize the relationship between banks and us.
Noted. I think thanks for explaining that really well. And I buy your point. In fact, it's a very important point that, if the fintechs are owning the customer, or if the fintechs have customer ownership, maybe they will have, what you can say, more cards with them, right, to showcase the game, win the victory, and win the game. Thanks for the clarification, Ranvir. Moving ahead, let me ask you something about customer ownership and the kind of the customer acquisition which the fintechs are making. So you are there in the segments is now, like I said, almost 6 years, we can say, and you have 8 million customers. You're profitable as well. But is the customer acquisition the biggest challenge for fintechs now, because most of the fintechs have obtained number of customers, and they have paid enough what you can say cashbacks, in fact, to have those customers on board. So going ahead, do you think that it's going to be really tough for the fintechs, in fact, to own the customer or acquire the customers, because the cost is also not very cheap, specifically to acquire the customers?
Oh, absolutely, Amol. You are raising a very critical point. Customer acquisition and retaining them has been and has always been one of the most ubiquitous problem any fintech has faced. And many people have solved in a different way. Given the fintech also means a very heterogeneous set of companies. And not to say one has worked versus the other, but different people have followed very, very different model. I think there are broadly 3 approaches which people have followed in acquiring customers. First and foremost, people have done what is called as digital marketing. People have spent money. those that money has gone primarily in Google, Facebook, many other, affiliates platforms, so on and so forth. At least we never believe that that is a sustainable or something which can create a competitive advantage for any company. Not to say that we haven't done that, but there are always players in the market who will be flooded with large capital. They can put more money during the IPL time. The rates only go up. We all go through the whims and fancies of how the market and the vagaries move with that. And I believe, any company which has built scale, of course, has followed this, but perhaps have not fully relied on that approach. And that's where I think the second and third approach becomes critical. I think the second approach is one of partnership. When so our model for acquiring customers, we go and partner with merchants. We have partnership with close to around 350,000 merchants. Who are these merchants, right? These are merchants who are small grocery shop, apparel store, restaurants, cafeterias. They can be pet shop also, sports equipment shop also, so on and so forth. Where any and every kind of transaction that is happening, or where our customer segment is going and visiting for either a buying of some product or experiencing some service.
Right.
Now, what it helps us do is it helps us capture the traffic or capture the flow of people who are coming to these stores. Of course, much easier said than done. Building that partnership is not easy. You have to partner with this vast number of people and so on and so forth. But once you have built it, you have actually created a very formidable moat, almost something which is very difficult to disrupt from a customer acquisition standpoint. And again, this is, as much as we may say this is more a fintech thing, people like Bajaj Finance have followed it for many, many years. And, in some sense, people like us have taken inspiration from that kind of model. So that's the second model, which I think many people have followed. There is a third model, which is a variant of the second one, where as against going after small stores, one goes and partner with, the large aggregators, Make My Trip, Book My Show, Flipkart, Amazon, Swiggy, etc., etc. Again, a very good source of, acquiring customers. The only challenge people like us see is, given they are big companies in themselves, the ability to, extract value through those partnerships is unclear whether they extract or we extract. The pendulum can swing very easily in their favor, but that's also because they have the benefit of large number of customers coming in, huge traffic, so on and so forth. Last but not the least, which is less of a direct way of acquiring customers, but there are some fintech companies who have done extremely well, which has played a big role in our acquisition as well, is once you create a brand and a customer experience, particularly in the segment you are catering to, there is a lot of pull. People like Cred, for example, have been able to play on that pull. Many people come on the back of the user experience they offer. And that user experience may not be felt on their own, but basically the product offering is so great that people talk about it. Similarly, we have seen on Ring, right? There is good 30% of the acquisition that happens where we don't have to spend any money. This is all the pull. And that's where I think the experience and what customer goes through, the faultless choreography of what you are offering to the customer when they come to the app are some of those things which may not seem important, but perhaps extremely important from creating the right customer experience standpoint, which adds to the acquisition in a big way. So combination of these factors which have led to the scale. I think future, if I have to predict what may happen in future, of course, digital marketing would always be a little bit of a dog eat dog kind of a, way to approach, acquire customer. But anybody who has built a strong network of partnerships, which allow us to cater to a large expanse of customer, my sense is we'll be able to acquire a much, much larger base.
Absolutely. I think show different aspects of what's happening specifically on the customer acquisition front, and give us different anecdotes there. Thanks, Ranvir. Let me shoot a very important question to you now. Since everyone realized that the credit is the only space where they can make money and not with the specific innovation in the payment side and all. And that's where I can see the rally. So obviously on one side, it's really nice to see you're profitable. But isn't, there a huge competition now, and in terms of chasing the same customer. Okay, I mean, we can obviously say that India is a credit hungry country and we have a large number of population. That argument will go on and on. But ultimately, the people, those who are maybe downloaded Cred, downloaded Razorpay, or downloaded some other fintech apps, is being also approached by some other fintech companies. So, isn't there a competition to target the same audience specifically from the urban or maybe metros?
You are absolutely right, Amol. I think you are hitting the right point that at the end of the day, the market would be big, expansive, vast. But as a fintech company which wants to build scale at an unimaginable level, I don't think we can draw false comfort just because the market is big and we will be able to play along with the competition. I think those are very, very ephemeral, thinking, and may lead to not being able to create a true differentiation. I think there are 3-4 things which has to be said about this. First and foremost, the competition is intense, and some of the competition here comes with very, very strong proposition. They are not, plain vanilla garden variety credit offering. They are basically coming up with very strong convenience proposition, and on the back of that, they are trying to give credit. That's where at least our sense is why we are so, I would say, positive, optimistic about embedded finance and transaction credit used as a synonym to each other. Because we believe at the end of the day, a credit offered as part of the journey will have a much higher acceptability and appeal as against something which is offered like a pure garden variety, plain vanilla, unsecured PL, as I mentioned. And though we strongly believe on that and not belittling anybody, the other reality of the market is there is a large number of competition which is completely devoid of differentiation. A lot of people are coming with a very Me Too kind of offering, and Me Too offering is not ready to, it's not something which is able to create a big dent in the overall space. My sense is the way it will evolve is different people are trying to create a different niche for their subsegments. So, for example, what would work with, say, our customer segment, which is mostly, I would say, mass market, but with a very high tech orientation, the new age, young people, the gig workers, income level wise, they are lower than perhaps what Cred may be catering to, and so on and so forth. And being able to create a leadership position by understanding the customer better is the key here. That's one part. Second, as you rightly touched upon, that many people are coming, they're trying to acquire the same customer. I think what is less talked about usually in the confines of conference room, but from a business execution standpoint, very critical point for us is how do I not only acquire customer, but retain the customer with us? Right. How do I ensure that these customers continue to bank with us and they are not attracting and joining somebody else? And on that aspect, again, being able to offer the right thing, a most customized thing, be it in terms of loan related offering, the right credit limit, being able to offer the money when they absolutely require it so that they don't have to, worry about other things. Plus adding that offering with many other things, right, which go almost synonymous with loan, be it protection product, be it savings product. People talk about neo banking, but some of those aspects intermingled with the credit offering becomes a key part of our offering. For example, just to play more on that, just to talk more about it, there is the repeat customer, what we call people who have been in the system. They almost contribute 92% of the value and perhaps 150% of the profit. For us, it is absolutely critical that once a customer comes in, the entire lifetime value is fully realized in a manner where they are seeing our proposition, they are sticking with us and continuing with us. And that's some of those things which will become equally important, if not just acquiring the customers, when we are trying to build the scale.
No, sure. So let me now shift my focus to specifically Ring, and maybe shoot 1 or 2 important questions there before we wrap up because the time is flying. So Ranvir, then, what makes you really confident that Ring will be really achieve maybe a next level of growth and maybe become perhaps the next Bajaj Finance because of the inspiration that you're carrying? considering everybody's getting into the lending space, considering everybody's using big data and AI far more aggressively and crafting, the loan in such a way that any customer can access it instantly. So what actually makes you confident, Ranvir?
Amol, I think there are two aspects which makes us confident that we will be able to build a scale which will be in the same level as two companies we value more from a scale standpoint. One is Bajaj Finserv and second is SBI Cards. SBI Cards today has upwards of 40 million overall customers that they have acquired. But of course, there is an attrition that they see. Today, we are at 8 million. We feel there are two aspects of our business which will help us achieve this. The first and foremost, the strong moat that we have created in acquiring customers. Today, as I speak, we are acquiring close to around 15,000 customers daily. I'm disbursing 1,500 crore every month, which is almost 50 crore a day. We believe, given we always run with the capital shortage, and for us, it is always a journey of fundraising and then, trying to deploy. If I just leverage this pool of customers and give them a longer tenure loan, which perhaps somebody like SBI Cards and Bajaj do, I can create a book of somewhere around 12 to 14,000 crore, which would be 1/3 of, say, SBI Cards book. So the first point I'm making is that being able to acquire customers and a large base of customers that I'm able to cater to is one, call it a sense of confidence that we are on the journey and we will be able to get to a scale which is, today very coveted scale by some of the players. Second, as I said, retention, loyalty, they continuing with us, catering to their lifetime needs are absolutely critical thing. There's a significant investment we have done. And mostly when we talk about, machine learning and AI, and needless to say, some of these terms have got cheapened with overusage. But mostly when we talk about that, we only talk about underwriting, using that to identify whether to give loan or not. In our case, being able to understand the propensity of the customers on what they want, we call it new product to buy. What is their new product to buy propensity? Are as important, as formidable as using some of these techniques for robo-credit or credit fraud underwriting and so on and so forth. So being able to create an offering which is on the back of data, both on the loan side and also on the transaction side, which helps us retain the customer is the key here. Today, we run with the numbers where the retentions are perhaps better than what some of the large companies are facing. My retention numbers maybe are best in the industry. And of course, much better than any traditional incumbent, even if they are a huge value. And that's the other confidence we have that we will be able to get to the scale that we are aspiring for over the next 3 years.
Sure, Ranvir. So you already highlighted what you want to do in the next 3 years, but that's generally my last question, which you already answered. But if you could add more to it in terms of what would be the step 1, step 2, step 3 going ahead, over the next 2 to 3 years plan that we just talked out, and also a very important question, considering it's a trend now in the startup and the fintech space. Fundraising plans, IPO plans, anything big that you want to do?
Sure. Let me lay out both of them. So on the first question, which is our plan over next 3 years, there are 4 different aspects of it which are worth mentioning. We want to get to a scale of, which is our business plan number, 40 million customers, of which a sizable portion defined as close to around 75% of them are active with us. By any stretch, that's a very, very aspirational number. But the way we are increasing with the number of customers we are acquiring every day, it's a matter of also achieving the same scale as we get to the journey. That's number 1. Number 2, from a scale standpoint, we want to get to a total book of 30 to 35,000 crore. The 30 to 35,000, we recognize that we are not banks. We will never have the same amount of capital which perhaps a SBI or a Bajaj will have. So it has to be built on the capital light model. That's the other evolution which has happened in the Indian fintech industry is banks have taken this role. Not only banks and incumbents and larger NBFC have taken the role of being a provider of capital in a rather non-competing way where we can work collaboratively with them. So we want to build a business in a capital light model where 85 to 90% of this 30,000 odd crore is what we call as off book, where I acquire the customer, but the capital deployed is from the banks and institutions. We are already running at 60 to 70% of that off book share, but we want to take it to a much significantly higher number. Last but not the least, we want to augment the lending offering with very logical set of customer demand linked offering, which are primarily around savings and investments. So interspersing lending with payments and the savings product, which we have already launched, but we see a big traction and we want to take it to the next level, being able to cater to the customer with multiple products. For us, in our ecosystem, we follow what we call as a rule of 7-2. 7 is number of lending products we want to sell, and 2 is beyond lending plus what are the number of products we want to sell. So we want to get to a rule of 7-2 for the large expanse of 40 million customers that we are trying to get to. So that's the aspiration that we run with over next 3 years. From a capital raising standpoint, needless to say, we will have equity rounds soon. Where we stand on that, I think we are still 1 or 2 rounds before the IPO. And as much as one may have a rather not so positive view on where the markets are, accepting all the new IPOs, but my sense is over a period of next 2 to 3 years, that may change. And that may be the opportune time for somebody like us to think of to go for an IPO. But what it also means is that we have to prepare for an IPO right from now, which is what we have started the journey. We may have 1 round happening this year. Here, when we are looking at the market, as much as there is a view in the market that, we call it, I think the word people use is the winter is long here and not many companies, the fundraise has become difficult. I can tell you it has not been difficult for lending companies particularly. And the interest is coming primarily from 2 quarters. And there are already some deals which have happened, which has also, augmented, fueled some of these sentiments. First and foremost, it is coming from private equity firms. Many private equity firms who were rather sitting on the fences, they have shown a keen interest. It's a cliche or a catchphrase to say that they are sitting with a lot of dry powder and they may be, wanting to invest, but we see that in our almost day-to-day conversation with them. And second, I think there is the first glimpse of, I would say, hope and optimism I see from a lot of growth funds. These are not the hedge funds who were active, say, 6-9 months before, but primarily the growth funds operating out of US, showing a keen interest in Indian market. And what we are trying to stitch from a fundraise standpoint is some combination of private equity and growth fund, which we'll use to basically have our next equity round.
Sure, noted your points, Ranvir. So quickly, you have started preparing for an IPO. That's what you want to say.
So we believe it's a journey. And when I say journey, if I have to put a time to when the IPO may happen, we are talking about more FY24 end or FY25 mid. That would be a time. But we are still 2 to 2.5 years away from there. And preparing for that just becomes the most, I would call it the most no regret, obvious things to do.
Noted your points, Ranvir. Thank you so much for sharing those points here at Fintech Diary chapter. And I must say that your points were really meaningful and realistic. So thank you once again for sharing your thoughts here and joining our special series, which is Fintech Diary. Thank you, ladies and gentlemen, for watching Fintech Diary. Stay tuned to etbfsi.com.